I think we're live. It still says it's preparing, but I think we're live.
Just
This
go.
is this is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Colin King. He's Value Don't Lie on Twitter, and he's Circle City Capital Group. It's a small business private equity using his own capital. We're going to find out more right now. How are you, Colin? Nice to chat to you face to face.
Yeah. Hey, thanks for having me on. I'm doing good today.
Welcome.
Tell us a little bit about Circle City Capital Group.
Yeah, I guess if I could rewind and go back a little bit further behind that, just my quick background, professional career started as a CPA, got my CFA, worked on the buy side at a fund, doing long only GARP special situation kind of investing. That's really where I got into the value investing philosophy. I met my business partner while there, and we both had this idea that, hey, we could buy a private company together, really before this whole entrepreneurship through acquisition thing took off, drawn to the idea of buying cheap cash flow and maybe it's passive income or whatever. And so we set out on the path to look at companies. We spent maybe a year looking at companies together, bought our first company together in 2018. And since then, it's just been kind of a cliche snowball of accumulating things. So we haven't started anything from scratch, and really we've funded through the SBA and bank financing. So we're still pretty highly levered, but it's mostly a bootstrapped company. It's not really like a thematic play. Like we're pretty opportunistic, looking at interesting deals. My original thesis was take the things I learned investing in the public markets, try and bring that to the private markets. And my partner is more of a operational sales and marketing type person. He used to work at Google. So it's a nice partnership where we bring different skill sets to the table. So we've done 14 acquisitions since 2018. We actually are getting ready to close on number 15 here in the next month. It's four groups of businesses that we run today. So several of those were tuck-ins. We got a consumer business. We make flannel. We make teddy bears. We make blue jeans. We sell that online and in a fleet of 10 brick and mortar stores. We've got a distributor of Montessori school supplies, a distributor of home decor products, and then a financial training and education company, soon to be an accounting firm as well. So that's what we're into.
Tell us a little bit about your first acquisition and what you've sort of learned along the way.
Yeah, it's everyone has just been a series of new learnings, right? And lessons to apply to the next thing. So the first company we bought together, Joe and I met on Craigslist. So back in, let's see, when did we meet? We met in like 2017, maybe. We both had this theory that, hey, if you're a business owner of a really small company and you don't know what to do with your company, you'll just put it on Craigslist. And maybe that's Facebook Marketplace today, but whatever. So he had a post looking to buy a company. I thought it was too well written to be some shisty person. So I reached out and we just kind of hit it off and kept conversation going from there. So we
Casual
found,
business encounters. Is that what it
yeah,
was?
casual. Yes, exactly. So we found a company on Craigslist about a year later, and it was a little trucking company delivering automotive parts in the middle of the night. So we bought that business just with our own personal savings in 2018. And if you go get your car fixed and the dealer is like, yeah, we'll have that part tomorrow. We were the guys that would show up at 4 o'clock in the morning delivering that part to that dealership. And so it was a horrible business. I mean, the first night that we showed up, I think two drivers called in sick. And so the two of us were hopping in a truck like day one to go do this stuff.
Ink's not even
So
dry on the contract. You're already
yeah, exactly. So the
passive
lesson,
income.
passive, yeah, highly passive. So the lessons were immediate. But it was good cash flow, right? It was a good cash flowing business. We had a nice contract, but operationally it was a disaster. So we ran that business and ultimately brought a management team in, kind of installed like a backup driver system, and we're able to peel ourselves out of it and sell that business about a year and a half later.
Mm. And why did you sell? Because you'd solved its problems, or you didn't want to be doing
The
midnight deliveries?
I can't claim this term, but someone along the way mentioned the term return on headache to me. And like that was just so true, right? Like it was disastrous for our marriages, disastrous for our personal lives. Like it just did not check any of the boxes, even if it was a good returning asset. So I still have PTSD, like checking my phone at 2 o'clock in the morning, like is someone's truck broken down 300 miles away from me? Like, do I need to go deal with this thing? Um, so it just wasn't a business model that we could see ourselves running and owning for a long time. Like if you can't do the thing of a company that you own in the small business land, like you probably shouldn't own that company.
So that was an important learning. There was like return on headache is a key metric. So
Totally.
how did you then start thinking about acquisitions after that? Did that like sharpen up a little bit what you were prepared to do?
Yeah, so we rolled the proceeds from that into an e-commerce company. This was back in 2019. And really the thought was, it's a way more flexible business model. You don't have to be physically located somewhere to, store, pick, pack, and ship a product. We used a 3PL. So we were more drawn to that flexible lifestyle sort of business. So now most of our companies operate remotely, with the exception of like production employees and retail employees and such. But all of our knowledge staff, they're scattered throughout the country. So we started going down this path of, can we lead with a better, more flexible operating style in the businesses we buy? So
And so talk us a little bit through like what's a prototypical acquisition look like in terms of like ratios rather than you don't have to give us the raw numbers, just in terms of like
yeah,
debt, equity, revenue
yeah.
multiples or EBITDA multiples.
I kind of view it as a stair step. So in the early days, our first deal we just bought with cash with our savings, and we didn't borrow any money to do it. And then when we sold that business, the next company we went out and got an SBA loan to buy. So we were putting 10% down, borrowing 90%. In total dollars, it was still pretty small. I mean, it wasn't a huge purchase price. We paid maybe half of revenue for that company when we bought it. So it was attractive earnings multiple, but we had to step in and play several roles in running that company. Like there wasn't a marketing team, there wasn't any strategy. There was a lot of administrative stuff to pick up. So, if you were to include your own comp in that multiple, like it would be less attractive. But, we've stuck to, paying half of revenue or three-quarters of revenue and just about everything we've done since then. And the real benefit is when you get to this like critical mass area, right? So, as a company gets larger, okay, now I have one person who's dedicated to running retail and one person who's dedicated to running ops and one person dedicated to this. So, that scale is a real thing. So we've benefited as we've graduated up that curve. But in the early days, it was highly levered, 10 down, 90 borrowed. In some cases, we had, earn out structures. And then, really in our the last couple deals we've done have been more in the, 25, 30 down, maybe some rollover equity from the seller and then borrow the remainder.
And what's like how often are you doing an acquisition? You've done 50, almost done
We've,
15 since 2017, so like a couple a
yeah,
year more than that.
yeah, at least one a year. So we've done one every year since 2018, at least one. Last year, I would say at this point now it comes down more to like how much bandwidth do you have, right? So if we were to buy a new company, it would either have to fit within an existing operating group that we have, so that team could go run it, or if it were going to be an entirely new platform, so to speak, then I mean we'd have to look at each other and say, all right, who's going to run this one, right? And like there's only so much time in the day, so it'd have to be large enough that we would have an operator who could take it on. So yeah, the criteria has changed. So last year we bought a company called Vermont Teddy Bear, which was a pretty sizable acquisition, just shy of 10 million in revenue. And so that folded within our consumer group. They're running that business. And the company that we're closing on here in the next 30 days is an accounting firm. And so that will tuck within our Profit Mastery financial training business. So like they'll kind of go hand in hand. So I'd say most everything we're looking at now is really dedicated to, does it fit within the portfolio?
So we've seen this rise of search funds or entrepreneurship through acquisition. Do you have any like advice for people who are thinking about going down that path and like what should they watch out for? What should they look for?
Yeah. So for like 9 out of 10 people, I would tell them not to do it. Um, just like full stop, full stop. Um, I think I've had a couple people reach out to me wanting to ask questions, how do you do this? How do you approach that? And I actually think the right thing to do if someone's interested in that space is to go find someone who owns a company and see if you can work in that business, as kind of a shadow to the owner, like be the right-hand person for a period of time because you're rolling up your sleeves, you're doing a lot of stuff, right? And it's not everything looks awesome on a spreadsheet and you think you're just going to be a passive owner and you're managing people and it's just so much more than that, right? There's just a lot of little things. I can't even come up with examples because this stuff you just don't know what you're going to get into each and every day. So getting your hands dirty and seeing what it's like on the ground floor, like I think that's the best place to start to see if it's something you could see yourself doing,
That'll
like
cure you.
yeah. Like if you can't do the thing that the business does, then you really have no business buying it. So that's really where I would guide most people. And then most of the search funders that I see, they're all looking for larger companies, maybe a million in EBITDA or more and growing or HVAC trades, whatever. I would actually take the opposite end of that and say look smaller. So maybe like 100 to 250K of earnings and then it's just the risk is lower and the complexity is lower and like the blow up potential is lower. Maybe you're more hands-on, more involved, playing, having more hats in that business, but it just will be easier to get your arms around. And then if you want to, you can come back later and like bolt something onto that if it's going well. So I would be more inclined to do that and maybe cobble together two or three 250K earnings businesses than to try and find $1 million EBITDA business that I think I could add a ton of value to.
I have some friends that kind of do some similar to this, and they've also focused on a pipeline of people and developing probably younger talent
Yeah. Yeah.
to then be able to put into the business kind of internal search fund practically. Have you explored that?
Yeah, it's funny. That's kind of where my partner and I are looking at each other and saying, what do we, what's next, right? Like we have a slate of businesses, we like what we own, and we like the people that run them. We're still involved in some of the smaller ones tactically, but I would love to find someone like me 10 years ago and say, you want to buy a business, and I'm confident that you know what it takes to run a business, and maybe they intern or shadow with us and then help back getting a deal done together. Like that's pretty interesting. I don't have to own 100% of everything that we do. It's not, that's not really high on my checklist. So we've talked about that. We've talked about doing some stuff in the public markets. I still love following the public markets and, doing some activist sort of things on the smaller end of the spectrum because, now we've seen what it's like to acquire a business or to grow a business or to turn a business around. And so if we can bring some of that expertise to smaller public companies, like that would be pretty fun too. And you don't necessarily need, you don't need to own 100% or even 50% of a public company to have some influence there.
Let me give a quick shout out Lausanne, Switzerland, Breckenridge, Tallahassee, Toronto, Valparaiso. What's up, Mac? Ostermalm, Sweden, Singapore. Danny Beltran's in Boston. What's up? Banja Luka, Bosnia.
Nice.
Toronto. GX. Sorry, I don't know what that is. You have to spell it out for me, team. London Town, Fremont, California. Bologna, Italy. What's up? Jupiter, Florida. Ben from Boise says, "What's up, Colin?"
Love it.
Bellevue.
Ben,
I think we could
or Colin, did your like public market expertise from before come in most handy for on the private side?
Yeah, it's funny when we started, I told myself, okay, let's steer clear of a couple of industries like restaurants and retail, consumer, and now here we are, like consumer and retail is our largest business. But it helped me look for things like like niche industries, niche markets, appreciating recurring revenue, appreciating proprietary products, and the power of a brand and exclusive supply relationships. So. I think it's added some little pieces that I've appreciated, but really my experience being an accountant and then being in the public markets has really made the due diligence process that much better for us. And then my partner having a nice ops background, like I think that's what's brought the most value here, and being able to speak public markets and put a balance sheet together and like figure out how to craft a capital structure. Like that's not that easy, even through the SBA. Like, I see a lot of business owners, not have enough working capital, right? Or not think about working capital, or not think about a line of credit, or they'll look at a business and they'll look at the full year results. And then you get down to the monthly or weekly view and you're like, holy crap, like this business is crazy seasonal. And if, it's what's the Howard Marks quote? It's the 6 foot tall man who's crossing the river that's 5 feet deep on average, right? Like you got to make it through the year to get to that full year result. So just little nuances like that I've appreciated. Yeah.
Yeah. I mean, I think Buffett said even sees candy loses money 9 months out of the year.
Yeah. Yeah. And absolutely. And so our flannel business, nobody's buying flannel in July, right? Like from January to August, it's a horrible business. I shouldn't say that to anyone who's on our team listening to this.
I love you guys.
Yeah, I love you guys. But it's hyper seasonal. It's insanely seasonal. And so on a full year basis, it looks amazing. But you got to get to September. You got to get to the selling season, right?
We've got to ask about your smart compounding strategy.
My smart compounding strategy?
That's what I've got. Ask him about his smart compounding strategy.
Oh gosh. Oh man. I don't know if I haven't trademarked that, but I don't know if I have a good compounding strategy other than, I think from that standpoint, I've met a lot of people who want to get rich quick, and whether it's public or private stuff. And for me, it's taken years of patience to build what we've built. But I'm kind of a diehard value investor, both public stuff and private stuff. Like I want to pay a fair or good price for whatever I'm buying, and then hold some of the levers to get the upside, and then just be patient with it. Like I don't know, that's been my approach both publicly and privately.
Yeah, that's really out of fashion, that approach.
Yeah. Have fun staying poor with that.
Well, that's why I love having the private stuff. So like when I set out to do this, I really wanted to be able to float between the two worlds, and I absolutely do. So like I'll go a week or 2 weeks sometimes if I get really busy on the private stuff and like will not pay any attention to the public markets. And then I'll pick it back up and I'm like, oh, whoa, okay, there's some interesting stuff going on here. So I am not necessarily a full-time public markets investor, and I'm not necessarily a full-time private market investor either. And I like living in that, in between. So
any aspirations to reverse merger into a IPO holdco?
Yes. Can I tell you about that? Oh my gosh, I have a huge desire to do that. So there's this thing called Reg Crowdfunding, and basically you can raise money from your customers, which is one of the most attractive ways to raise capital. And not that we would want to take advantage of our customers or anything, but like you give them an opportunity to buy in. They don't have to be accredited, and the minimum investments are lower.
Is this like Kickstarter?
Basically Kickstarter for a small business. And the requirements are, if you have reviewed financials, which is a step below an audit, you can raise up to 1.25 million annually from your customers. And if you have audited financials, you can raise up to 5 million annually from your customers. And what that does is if you've got a large enough customer base, which in our consumer business we've got, I don't know, maybe 1 million people on our email list, then you have a wide shareholder base, right? So I can raise capital from my customers. I'm a C Corp setup. It's like an SEC light kind of offering. And now I have a large shareholder base. And if I do that as step one, then step two, I could go find a market maker and put my shares on an exchange and get a quote. And so I don't have to IPO because I've already raised the money from my customers, created that large enough pool of ownership.
How do you determine valuation on that?
So the exchange, these are like FINRA regulated entities that do these Reg CF offerings. There's a couple of them out there. Republic is one, Republic.co, Start Engine, WeFunder. So you can look them up. You can go see these companies that they're issuing capital for, and you can invest in them if you want, a couple $100 a pop usually. But valuation, they work with you to determine what would make sense. I think it still has to.
You can't.
It still has to fit. It can't be outrageous.
You're going to have to wait till a SPAC to do something really stupid, right?
People, I mean, I looked at a couple of the deal profiles that were on there, and people were picking it apart. So, they were asking some good questions. But anyway, that's my dream. I'm still trying to convince the management team of that business that it makes it makes sense to do that, though.
Any sense of how much it costs to have like your own liquid little market for your internal shareholders
Ooh,
on an annual basis?
no, but that would be amazing. I'm gonna write that idea down.
I guess you get a wide bid
I know some of
ask.
the VC world, they have some of these kind of secondary, like,
Yeah,
they're effectively private markets to allow people within the capital structure to change seats, but
yeah,
a
yeah,
lot of them are negotiated transactions.
Do you think of it like a conglomerate, or does each business is its own? Is it like a private equity firm, which each acquisition is its own thing, or is it
yeah.
conglomerate style where you like?
Yeah, it's everything runs on its own. It's so we don't force shared services on anyone. So we don't, you can go get your own tech stack for this business, that business, whatever. I will say the largest company to the next largest company is a pretty wide gap. So, Joe and I have I would call it a full management team in our largest company, and then the next two smallest have like a GM running them, someone who understands the business, understands the ops, but they need help setting strategy or managing the P&L. And then in one of the businesses, I sit in the driver's seat for that as CEO. So it's
But
kind of
if
a
they
mixed
are going to
bag.
buy teddy bears, they have to buy Vermont, right? Like that's
100%.
okay.
Yeah, yeah, 100%. There's only one flannel supplier
No
or base.
negotiating on that.
No, no, zero negotiating on that. But no, we don't force shared services. I mean, like I said, this has just been like totally and completely opportunistic, just kind of like bolting things on as we go. We're not trying to set out to create some end game and reverse engineer that.
We talked about this a little bit before we came on, but there is this like wave of, it's been around for a long time, but it does seem to be like getting louder and louder, this wave of entrepreneurship through acquisition or search funds. Um, have you seen increased competition? Have you actually seen more people out there trying to buy alongside you?
I we don't compete we don't compete in auction processes. So I don't know that we've ever like lost a bid from that standpoint. Most of the companies we're looking at, I think most people would not be interested in buying them for one reason or another. Um, I do know there are more buyers out there. I mean, I get emails all the time from, ETA folks who want to ask questions or, want some guidance.
You got to start a
So it's
consultancy,
I don't know. I
Oh
don't know
man.
about
hire one
that.
person.
So it does feel like the buyer pool has increased. I haven't really seen, and I don't have any definitive data on this. I haven't looked it up, but I don't know that the supply of businesses has necessarily increased to keep up with that. So it feels like demand is up, but supply is flat of businesses available. And I don't know how that changes depending on the size, right? Like one million above or below from an earnings standpoint, but it feels like there's more buyers and fewer businesses to go around, at least at the moment. So the silver tsunami or whatever you want to call it,
Yeah.
I don't know that I've seen that playing out. And multiples seem to be getting richer, not cheaper in private stuff, even
That
on the small end of the
silver
spectrum.
tsunami's been discussed since before Toby and I were
Yeah.
silver.
That's right.
I
It
didn't
was
realize we were the silver tsunami.
when I started, like when I started
Yeah.
20 years ago, that was what people were like, more than 20 years now. That was the silver tsunami is coming.
That was the
Everybody's
name of
getting into
it, even
private.
back then?
Yeah, yeah.
Oh,
I mean, that was when the boomers, I guess, like what are the boomers now? Are the boomers 80 now? So I guess they were
Nah, they're a
60.
little bit younger than like the
What's the
the
first boomer? 45?
yeah, something like that. Maybe a little bit older, right?
That's 45 to what, 55? That 1945 to 1955. That's 80 to
yeah,
70 to 80.
yeah,
So they were 50 to 60 then, which is like, that's probably right. Like there was a
Spring
silver
chickens.
tsunami coming. It's still
yeah.
coming.
I think that's absolutely right. I mean, I think they're holding on. Most owners of companies are holding on longer and can, right? Especially if they've built a larger company with a team around them and stuff.
Mm.
Most of the deals that we've done have had like I would call it low 70s aged sellers. Um, so yeah, I don't know. I haven't seen it yet. I think they're willing to hold on longer, and the mispricings aren't just they're not there quite like they are in the public markets. Like you're not going to buy a business at 1x earnings unless you can bring something really uniquely value add to that situation.
Do rates impact? Like, you were? Did you invest? Was it zero rates when you started, and they've like
It
come up?
was, yeah. Let's see. When did rates really start kicking up? Really around right around
22.
pre yeah, COVID. So rates were near zero. So borrowing was pretty cheap. Um, and if you're borrowing with the SBA, the 10-year it's the amortization that matters in these small business deals. So like if you're amming your debt, if you are 90 or 75 levered, then the am is going to matter way more than the rate. So a 10-year am loan will give you plenty of flexibility if you're paying a low enough multiple for it. But once you get out of the SBA and do conventional stuff, then they're like, yeah, here's a 5-year AM, or here's a 3-year AM or a 4-year AM because they want it to like match the collateral, like the tangible
Yeah.
assets in the company. That's when things get real dodgy, especially with the rates. You're like, oh, whoa, wait a minute, that's a lot of cash outflow.
Yeah.
Yeah, you want that 10-year fixed balloon payment.
For sure. I mean, that's the secret sauce that makes it work. Like without that, it'd be pretty challenging to buy a company and no way would it work at 10 down, 90 borrowed. And even 10 down, 90 borrowed, like I don't knowing what I know now and where I've been, like I don't think I would do that again. So like I
Yeah,
think
I
there
was
was
going
a
to
time
ask
and a
you,
place for that.
do you feel path dependency risks with that kind of leverage profile?
Yeah, I mean, so fortunately we've ammed a lot of the debt that we have. So we still have leverage, but nowhere near what we had, when we were doing in the, early days of SBA loans. So I think I couldn't tell you how many times I've used the phrase we're flying too close to the sun to my
Yeah.
partner. And so like I just don't want to do that anymore, right? So I think if we were to do anything from here on out, like we would either bring in equity or we would borrow way less than we have in the past.
Is that success that's making you feel that way, or is that just a reality of the?
I think I don't
Oh,
know, maybe a little bit of both, right? Like, I think if you get some scale and you see some success, like there is some truth that you take your foot off the pedal a little bit, right? Like so early on, $1 million deal, I think we both would have looked at each other and said, yeah, let's lever it up and go do it, right? Like we can make it up, we can make it work. And once you've accumulated something, right, you have something of value, it's like, okay, well, shoot, I don't want to lose it. I
yeah.
don't
Yeah.
want to lose it because of this other thing. So,
Don't
you know,
risk what you have and need for what you don't have and don't need.
exactly. Yeah. So I think that definitely changes some things along the way. So we would probably invest a little bit differently today, unless like an absolute game-changing situation came along.
I'm sort of surprised that we haven't seen more of the silver tsunami or the search fund. Like I feel like that's been coming for a long time, and I feel like the boomers are kind of running out of runway a little bit. Like the older boomers are running out of runway. Like,
Yeah, and really, I think about those businesses and if you're so think about the content or the comment I just made, right?
Toby's trying to
And
kill your grandpa, by the way.
I'm not. I'm just like that's the reality is the reality.
well, so the thing about how much they're taking their foot off the pedal, right? Like if you're 75, you're in
Mm,
like full on protect this thing mode.
Yeah,
So like you're going to pull back massively from a risk taking standpoint and just like keep it down the fairway. And
yeah,
then you've got COVID impacting results in a lot of industries. So it's like, oh
yeah.
man, it gets kind of murky, but it could create really interesting opportunities if you find a business where the owner took their foot off the gas and you can come in and just do one or two or three pretty simple things that they were either unable or unwilling to do. Like that could be pretty fascinating.
I've heard some convincing arguments that AI might actually be more readily applicable to see smaller businesses when things are just on paper or, like
Oh,
there's
absolutely.
incredible labor savings you might be able to, or efficiency gains you could find.
Build me a template. Yes, absolutely. I mean, the amount of manual stuff it would blow your mind. Even at like the larger side of the spectrum, like I mean, we bought a business with more than 5 million in revenue and they didn't have online banking. And it was like, okay, let's go figure that out. Like, let's just do a couple of things here. So yeah, you'd be shocked at the way that some of these things operate.
JT, top of the hour, you want to give us some vegetables?
Yes, sir. So this is a segment that's on the fable of the bees, and we'll get into it a little bit more. But one of my deeper held beliefs is that capitalism provides the biggest pie, and also generally business done right is very win-win oriented and is pro-social. But it's always good, I think, to try to kill your babies whenever you can, and or kill your darlings, I should say. That was kind of a weird way to say it. So this is a little bit of an exploration in that direction, and so we'll kick things off with a little bit that so saints give the great speeches, but it's the strivers and climbers who actually pour the concrete. And our highways aren't paved with virtue, they're paved with vanity, and that's why they exist at all. Or so thought a man from the early 1700s named Bernard Mandeville. And he wrote that private vices, public benefits. And that's a line from he has a strange little poem, and it was later expanded into a book, which was called The Fable of the Bees. And in the book, Mandeville imagines a thriving beehive filled with liars and cheats and gluttons, and every bee is incredibly selfish, every bee is vain, yet the hive is prosperous, rich, inventive, full of energy. But one day the bees decide they're going to become virtuous. They give up greed, they stop lying, they live simple and honest lives, and the hive completely collapses. Without vanity, there was no fashion. Without ambition, no innovation. Without envy, no progress. And Mandeville's moral was a society without vice doesn't survive. Now, this idea shocked a lot of people 300 years ago, and it kind of still does today. Because Mandeville's claim is not just economic, it says something profoundly uncomfortable about us as humans. Like, we need flawed motives to do great things often. And we like to think that progress comes from all these noble intents: compassion, curiosity, justice, love of truth. But if you scratch the surface, you might find something a little bit messier. People start companies just to
impress a girl.
Well, yes, that's correct. You're jumping to the punchline, but
sorry.
Yeah, no, that's okay. You're right. You think it's like to serve others, but often maybe it's to prove something to the world, to their parents, to the haters. And maybe if we dig deep enough to curry favor with the opposite sex.
Sorry, brother.
No, it's good.
Step on that
one. Even acts of charity often carry these traces of pride or guilt, like why else put your name on the building, right? So Mandeville's genius was to say, like, that's fine, that's human. What matters is not purity, but direction. He looked at society the way that a naturalist would look at an anthill, with kind of a detached curiosity. Like, what keeps this thing moving? What sustains the energy? And the answer he found wasn't virtue. It was appetite and avarice. We're driven forward by our wanting, often mimetic in nature, by advertising manufactures lack and then rinse you the relief. And while we like to moralize about these factors, civilization itself may actually depend upon them. And so Mandeville understood what economists like Keynes would later formalize into overly precise mathematics. Demand, even wasteful demand, keeps the world turning. And now, granted, some vices don't create; they cannibalize. Fraud, coercion, zero-sum gambling dressed up as innovation. These probably aren't really fuel. They're probably more like fires in the rafters. But it's never been easier to chase that dopamine hit of gambling in every spare moment. Sports betting, prediction markets, fantasy football, even large swaths of the stock market today. It's really a gambler's paradise. And I'll leave you guys, I'll let you openly debate the merits of OnlyFans, different vice. So the question isn't really like, is it vice or virtue? It's which appetites compound, which destroy, and what guardrails kind of turn this heat into light. And how can we price externalities, punish predation, and reward creation over extraction? So, we often hear that to be better humans, we must overcome our desires, our base instincts. But maybe it's kind of the opposite. Like, maybe the task is to work with them, to transform them, to give them purpose. And that's why I think Mandeville's phrase, private vices and public benefits, might still resonate today, even 3 centuries later. And in a lot of ways, it's kind of this hive has kind of necessarily disappeared, but it's definitely gone online. Like, open on a scene in a creator's analytics dashboard at midnight, following counts of ticking, follower counts, and brand emails pinging, a half-edited reel waiting for the perfect hook. This digital economy really runs on vanity and envy and attention. And social media has really turned all of our narcissism into infrastructure. And so it's really the hum of the hive there. And all of our private impulses to be seen, to be admired, to belong have really been monetized against us. So, and I think Mandeville would have understood all this perfectly. He would have said, of course, that's just the hive humming on hypocrisy. So I think we've taken a lot of these moral revolutions and even monetized them. So green products, ethical fashion, socially responsible investing, they let us feel virtuous without really changing that underlying engine. And Mandeville would probably suggest that humans can't escape their drives, so we need to learn to rebrand them and we try to domesticate them, basically. I'll try to wrap this up now. 3 centuries later, the hive is still humming. There's this uncomfortable takeaway that perhaps we don't rise above our motives, like we just kind of ride them. And probably the work then is to choose better saddles at that point, build the rules that can help price externalities, reward creation, turn status seeking into service. Maybe not expecting purity from everyone, but opting for better plumbing. So I try to go a little bit counter to my pro-capitalist ways that have a high proclivity toward, but just pointing out that maybe there is a little bit of a seedy underbelly sometimes that it's easy to forget about.
That was a good one, JT. Maybe one of your best.
Really?
Folks say very uplifting veggies. Ray Polk says, I live a life of virtue built on a throne of vice. I like that. Something like that. I think that even the gambling, whether it's that poly market style where you can gamble on the outcome of presidential
fucking
elections, anything, yeah.
Sorry, pardon my French.
All of the gambling, like you can use that stuff to hedge. I think that even zero sum stuff is worthwhile if there's one end of it that allows you to hedge an idea that you have or hedge your business or whatever. Like I do think even the zero sum gambling has some virtue in it. And I say this as someone who doesn't gamble.
Which makes you allowed to say it.
Yeah.
There you go.
Hive mind,
I'm
kill
defending
him.
it. I'm defending it, even though I'm not personally invested in it. What do you think, Colin?
Yeah, I think about
Colin is at the coal face of this. How do you feel?
No, actually what was coming to mind as you were talking about that is just some of the level of crazy I think that's required to create in the world, right? So I think about someone like Elon Musk, and say what you will about the guy, he is maybe a crazy person, but has created a lot. And I am thinking about that on a more personal level, and some of the companies that I've bought and some of the founders that have created the businesses that we bought, and like I'll tell you, man, they got an ounce crazy in them, right? You almost have to be able to do that and create something like that, and whether through all the shit that you've got to go through to build a real business and scale it and everything. So, I was taking it as, the world needs a little bit of crazy to be able to create and build those sorts of things. And so I think a lot of people look down upon crazy people in that sense. I'm not using it as like literally crazy people, right?
Although maybe, there's like a very fine line between genius and insanity, right?
Yes, it is, right? There's definitely shades of gray there. So I don't know how you'd put guardrails around that, but like I think the world needs people like that, whether you like them or not, because they build, right? They build things that wind up becoming important to society down the road. So yeah.
Is Musk the greatest entrepreneurship through acquisition person ever?
I mean, objectively, probably, right? I mean, yeah, like just tally, yeah.
Because Tesla, I guess he's
yeah.
No, he didn't. I think he has had himself updated to a founder, which is probably fair. Like like the Tesla that exists today is clearly
it's
like
a little different than what he probably when he took over.
Vastly different from the thing that he took over. Yeah. I guess he started SpaceX though. Good to give him.
Yeah, the world needs a little crazy, man, just a little bit.
Sorry, go ahead, TC.
I was just going to say, it's just a throwaway. I like that line. We don't do this because it is easy. We did it because we thought it would be easy.
Yeah. Yes.
Yeah, that's exactly right.
Sorry, JT.
I was just going to say there's an interesting book that came out recently on comparing China and the US, and a lot of it was about the leadership styles and China being primarily run by engineers. The CCP is made up of, I don't know, whatever, 95% of them have engineering degrees. And so they're really good at building things, and they just like get things built there. And the consequence of that then is that and there's like KPIs for things. And so when you boil humanity down to like one number, you end up with some very I don't want to make moralistic judgments, but short-sighted when it comes to humans' liberties and freedom and happiness on us gets sacrificed often. And in comparison, the US has been run by lawyers. Like we have basically every president has a law degree, and all the Congress is all made up of lawyers. And they're really good at stopping things from getting done. And so that's like what we end up with is a lot of, we do up until recently, do a pretty good job of protecting civil liberties. And then, but at the expense of like sort of like just getting shit built.
Being practical, yeah.
Yeah, you lose a practicality to it. And so probably the middle path, like always, is the correct answer. But it's interesting to see those two societies.
You wind up having two types of person at odds with each other, right? Like the formulaic, data-driven people are like fundamentally don't like the creative and loose cannon type people, and vice versa. And yeah, if you've got one cohort leading it, then they're going to want to have all people that are homogenous to them, right?
Yeah, so you over-index to that, and then you end up with like, one child policy or zero COVID, and there's like some pretty extreme, social consequences from that.
I forget who said this exactly, but there was I think he was an Australian mining engineer by the name of Lang Hancock. He used to say that when he would buy these mining companies, and they have an exploration budget which consumes a lot of the money that the mining companies make, and so he would shut down the exploration. But the moment that you shut down the exploration, you lose all of your blue sky, optionality in the business, and so the multiples that people would pay for these businesses would like sink to basically they were like financial acquisitions at that point.
Yeah, so he basically
he figured out
he
figured out you had to have some blue sky optionality in the guys going out and looking for new discoveries, which I guess is like a tech company having R&D, or that you've got to have that wasteful spend at the limit.
So I love that train of thought, because this idea crossed my mind a while back. Like, how Buffett got into the insurance business and then used the float to fuel what is now Berkshire. Like, I think about the oil and gas industry and really similar thought process to mining. Like, if you've got these reserves and they have a runoff value to them, and most companies tell you, here's what that runoff value would be, discounted even. Like, if you could buy that runoff value at 50 cents on the dollar and then control it, shut off the exploration budget, right? So it's just runoff cash flows, and redirect all those cash flows into something else. Who cares about the market multiple? Like, couldn't you theoretically control that, buy 50 cents on the dollar, and then take that dollar and go redeploy it into other stuff? Like, I don't know. I guess I have a dream of like, I want to buy a tiny oil and gas business at 50 cents on the dollar, shut off all exploration, and then go buy some other stuff with it.
But here's the thing: you could take those earnings and keep on buying all of these other oil wells at 50 cents on the dollar.
Yeah. Keep doing more, right? Yeah, absolutely. I'm surprised that I haven't seen anyone do that yet, or take that approach, right?
I know one public company that's done that.
Biglari, is that?
Yeah.
Yeah, that's what I thought. I haven't seen any math on it, but someone did tell me that they're trying to take that approach. I think it's super fascinating. So if you ever find something in my price range, which is probably too soon, let me know.
Yeah, it's worked out quite well for him.
Really?
Yeah.
Okay.
Specifically really buying the oil wells he's bought one, right? Has he bought more than one?
More than one.
Okay.
Yeah. A couple different projects. And the idea is really like you JV with someone else to actually do the production.
They do the work, yeah.
It turns into a royalty that you just basically like pay
man. Sounds amazing.
Yeah, it can be. He bought well too. That's the key. You have to buy well.
But yeah. Know what you're doing.
And then you just sort of wait till you get the price that you want, and then you like turn that into cash when it's convenient.
Yeah, so the market will never give you full credit for it, but like if you can do it, generate good return, and then redeploy it smartly, then it could be really interesting.
A couple of good lines here. Howard Marks says people put premiums on possibilities and discounts on reality. That's good.
Yes.
And then
Imagine that. He said it well. Hard to believe.
Yeah, so Howard Marks has been unusually not bullish, but not bearish, I would say, recently.
Mm.
which is funny because I think he was more bearish with the market lower and less speculative than he is today. And then I saw yesterday he's sold his remaining, like,
Sold up, yeah. Oh,
he's shifted the last share of Oaktree to BAM. So now you probably get to hear what he really thinks.
bam, indeed.
Tide's
$3
turning.
billion dollars in the bank account.
And the interesting thing was that BAM had said that they thought that they'd hold that they were in partnership with these guys because it was only with a 35% share that they were left with the Oak Tree guys, and they've put it to them maybe right at the top of the market. Who knows?
Mm.
Get any view there, JT?
Yeah, I'm not sure I would want to ever grant Howard an option. I think he would I think he would know when to exercise it at a time that was disadvantageous for me. Especially when it's his business he built.
What do you think, Colin? You ever do deals like that where you leave founders with a third share and like the option to put it to you?
Yeah, we have done that a couple of times. We've done some seller rollover equity. We've done some earnouts. We've done some seller note in a couple different situations. I do think I think at this point, having done this enough times, I feel like I would favor a clean break, right? You know, especially if it's something that someone spent 20 or 30 years building. You know, you probably want to set the precedent of they're out of the way and you're running that company from then on. But, you know, then they just have expectations that you've got to meet in different ways. So they may care more about, you know, what you're working on and how things are going and other things, even if they're, you know, only a minority owner. So I probably would be more in favor of clean breaks on stuff. But you know, I did just finish the John Malone book, the Born to
Fable
Be
Cowboy.
Wired. No, the new one that he
Oh, okay.
wrote. Born to Be Wired, I think it's what it's called. And I was really taken aback by the quantity and frequency of JVs and minority deals and partnerships that he's done in building Liberty. And I know Liberty has always had lots of minority stuff and like investments that weren't necessarily wholly owned or controlled and cash flowing back to the mothership. But it just, I mean, even back in the 70s, 80s, 90s, he was doing JV type stuff left and right, partner with people to build this thing, build that thing. So I don't know. I, I haven't, I don't have like a firm grip. Like I got to own 100% of everything I do. Some people feel that way, but yeah, it'd be nice to have a collection of bets and have good partners working with, you know, you bring skills to the table, they bring skills to the table and you kind of share the spoil. Like, yeah.
Yeah, that's the problem with a 100% deal. You got it all, but it's all down to you. Whereas
Yeah.
if you got a
You got to
partner in
figure
there,
it
they've
out.
got a
You
little
got
bit
a
of
real bozo at the helm then.
yeah, that's a problem. Austin has a good line here where he's talking about we're just on the letting the world run down. So Oxy is probably close to being in that kind of realm, and Buffett certainly had been at pains to like hold Vicky Holub
Scoop
to
up the
the
rest of that.
to that
Yeah.
deal. But then Kraft Heinz, do you think Kraft Heinz is that in runoff?
I don't know. Do you think, I mean, those are big enough brands that I don't know that those are like, I wouldn't necessarily call them secular decliners, right? Like maybe they'll struggle with just the ease of starting up a new consumer brand in the, you know, food and bev space. But like I don't know. I don't know that those will ever truly go anywhere. I can't speak to some of the stuff smaller in their portfolios, but I kind of still view them as Procter and Gamble-esque, you know?
They were kind of a lock when they were limited number of TV stations, limited amount of shelf space, needed to have a
Yeah.
brand that cut through that everybody recognized and then just dominate that space, that mind share. And now it's so much more fractured. People can order online and they get their information from social media or whatever it might be.
Yeah.
So you can start up something that would, it's not,
Totally. It has changed the nature of the grocery business too, right?
yeah.
Like my wife and I, you know, we've got small kids, and so we order our groceries online, save the time of, you know, going dealing with that. So yeah, it absolutely makes it easier to buy different brands, different products and stuff. More of an e-commerce type play.
I feel like some of those brands have like they've hollowed themselves out a little bit by using all of those just terrible ingredients that they're obviously cheaper and so it increases their profit margin, but it's so bad for the people who eat them that it's just left this open field for people who want to come and make them either the way that they used to be made or
Yeah.
a slightly healthier way. now. And that's like, I've seen so many brands make inroads into our fridge, into just generally.
All right, California hippie.
Mate, if they made some of that stuff the way they used to make it, like put the, not lard, put the,
Beef tallow, baby.
yeah, put the tallow back
yeah.
in. Give me the beef tallow fries.
My wife's litmus test is just, what's the quantity of ingredients on the list? Not necessarily like,
Yeah,
that doesn't have to be perfectly clean, but it's like, all right, if it's 3 paragraphs long,
yeah.
like there's got to be some stuff in here that I shouldn't be ingesting.
That's probably that's the best heuristic. Just the shortest list possible.
Yes. That's why I like Haagen-Dazs. Oh, I love ice cream. Haagen-Dazs has like 3 ingredients in it. It's like, okay,
Yeah.
feel pretty good about eating a whole pint of this.
Is that the takeaway?
Yeah, that's the takeaway.
If it's high enough quality, then you can go as much quantity as you want.
That's right. Trade-offs.
Colin, you're looking for mostly local type deals, or you look anywhere? How do you
No,
how do you
we'll
think
look anywhere. We don't actually own anything that's local to us. I think we've got one employee. We've got one employee in Indiana where we're based. Both my partner and I are here in Indianapolis. We've got one person at one of our businesses employed here, soon to be two. So we'll look anywhere. It's managing a remote company can be challenging, and so that's why I think we would still have that same lens of it's either got to fit within something we already own, or it's got to have an operator or some way to fit into the overall portfolio. Which is why I like this idea of finding a 20, 50, $100 million market cap company that could be like a friendly activist play where we can come in, maybe put some capital to work, partner with an operator to help, deploy capital, whatever, and add some value and things that we've learned along the way. Like that seems kind of interesting to partner with someone in that regard.
Yeah, for sure. What's tax time like? It's just a nightmare with 15 entities.
It's not fun.
We
It's not
shouldn't have
fun.
outside investors.
Occasion we've got outside investors in one company that we own. We did like a friends and family round to help get a deal done a couple of years ago, and the sellers rolled some equity in that business too. So we got like K1s and stuff to deal with there. Tax is pretty unpleasant, just generally speaking. And my partner is always like, "Hey, I'd love to get our taxes done by the 15th this year, April 15th."
Like,
and I'm
no
like,
way.
"Yeah, I set your sights to the fall, man. Like I think it's going to take a couple of months to work through this stuff." So
I think you can extend it to October 15, right? It's like tomorrow.
yeah, tomorrow. Yeah, that's right.
Now
That's
you tell
right.
me.
We're done. We're good. We're good in that regard.
Better get
but
started.
yeah, better get started. Oh no. Yeah.
You guys know, I'm not sure who, Austin, are you talking about Marx here? He says Marx is selling a ton, he's selling a ton of brands via 3G, buying small, high margin businesses in developing markets. Buffett,
Karl
Planners,
Marx?
Oscar Mayer, Maxwell House, cheese brands in Canada.
I feel like even though the markets seem expensive on the whole, I'm still finding like a decent amount of pretty good ideas in the value space. And there's stuff that still seems pretty recessionary, like trucking, transportation stuff. But I don't know. I'm still finding a decent amount of like reasonably cheap and decent ideas. Especially companies that are. Sorry, go ahead.
I was just going to say, other than that very top layer of the very, very biggest companies, and who
Yeah.
knows, they might be fairly valued if the singularity and that all happens. But everything else seems to me to be like pretty cheap. There's a
Yeah.
lot of value around. And I agree,
Yeah.
trucking's bombed out, and trucking's also got with ICE taking a whole lot of foreign drivers off the road, they're having trouble finding seats. So a lot of the rates are going up, which is probably maybe good for trucking. I don't know. Maybe the volumes are going to stay down. I don't know.
Yeah.
Is it just a fear of recession? Is that what's driving is that the narrative?
I think there is a little earning. There's definitely a little earnings. Like from 22 to today, smalls are all down. Even S&P 500 earnings are down from 22 that are up on operating earnings basis.
It feels like there was that period of super normal earnings post COVID, right?
Yeah.
Like the demand spike, whatever you want to call it, and it impacted tons of industries differently, and so that tail was longer. It seemed like in a few industries, but I think we're still churning through a lot of that stuff. Like look at a lot of these building suppliers, like Atcore, ATKR. I don't know if you've looked
Yeah.
at that company. Like
Yeah, I own it in my
two,
small.
$300 stock. Now it's down to $60. So
Yeah.
Stanley Black and Decker, like, oh my gosh, I just was looking at that the other day. And some of these companies, I feel like they're still just trying to figure out what a normal year looks like even here in 2025, 2026. And
Yeah.
trucking, I think, fits into that bucket of super normal earnings. Now it's leveling out. They're trying to figure out, okay, what's normal really going to be?
You can still see the pig going through the python in a lot of those, like 22, all that stimmy, I guess it pulled forward a whole lot of demand. And then
Yeah.
we're still working through it even now. I don't know if I feel like we're getting closer to trend here. And then maybe there's a little bit of weakness and maybe some of them are a little bit below trend.
Yeah. I've tried to make this like a bucket of companies to look at. I just call it like super normal earnings type companies, post-COVID, situations. I don't know when the right time to get involved or interested in some of those are, but I feel like I want to watch a basket of those types of businesses, because at some point those industries will turn and go back to normal, so to speak, and they could be really interesting.
How
It's
are they?
very,
Are
yeah.
they growers or showers?
Yeah, yeah. I mean, dude, Stanley Black and Decker. We go back to this one. They came off of a COVID year of earnings, and I think it was, I don't know, $7 or $8 of earnings per share. And then I think it's for this year, 2025, they were like, yeah, earnings are going to be zero, literally nothing. And then next year it'll be back to, I don't know, $5 or $6. I'm like, oh my gosh, like, can you imagine like being
Just
that big of a
taking
company
write
and just
downs? Is that what?
yeah. Well, no, that's just from like their core business. That's their non-GAAP number.
Wow.
Like, oh my goodness. So you just have these companies that are just kind of taking it on the chin from, a whole bunch of different things, whether it's, inflation and costs, supply chain, inventory, whatever, just a number of different issues.
These
How
problems
are
are
there not
easily
more
solved. Stick
bankruptcies?
AI and get those things in Sydney Sweeney's hands and you're money good.
Power tools. Yeah.
Yeah.
Sorry, JT.
No, I was just gonna say, like, if you think of if that's let's call that kind of maybe a potentially prototypical example of maybe what private equity would have bought and levered up. Higher financing costs, maybe, weaker business. Like, where are the bankruptcies? Where are the
Totally. Yeah. Like, why haven't those shown? Because a lot of these companies, like the reason that Stanley got into that space, and I'm looking at another company now called Leggett and Platt, LEG is the ticker. They did the same thing. During COVID, during their super normal earnings period, they levered up to buy another business
of course.
experiencing super normal earnings, right? And then so then like they layer on a whole bunch of debt and get hosed as both of those things unwind. Like, yeah, I'm surprised there haven't been more bankruptcies. I guess there have been in certain industries, like some industries have been hit more than others. Like, think about bedding and mattresses and, retail, furniture, retail, and like, cons and all those kind of low income type demographics. Like those were hit pretty hard.
I actually thought you were going to say you're surprised there weren't more private equity deals going through because like Crocs is an example of something out there that I just think Crocs is like $4.3 billion market cap at the moment, and it's got like $960 million in free cash flow on that market cap. So like that's pretty good. That's like almost a small private acquisition.
You can lever
I
that
thought,
up.
well,
You can lever that up.
they got
With someone else's money, yes. Yeah.
Sketches got done at $13 billion. So clearly, like it's right in the hitting zone for some of these guys. And I get like it's faddish. It's a single weird shaped clog that goes in and out of fashion. I don't know. I feel like there's a potentially a big wave of private equity deals coming, but then private equity's got its own problems trying to digest everything that it's done over the last 10 years or 20 years.
Yeah. Maybe they're struggling selling stuff, to be able to generate what they need to, I don't know. Yeah, they talk about the dry powder that's out there, but yeah, I mean, I'm seeing a whole bunch of companies with like real businesses that maybe the industries were in a downturn, but now they're pretty stable and they've either sold some stuff, right, to get debt under control. Went from like 3 or 4x levered to 2 to 3x levered. It's like, okay, those are pretty interesting at like a single digit earnings multiple. Like, yeah, I'm surprised that you wouldn't have even smaller private equity firms interested in that.
Colin, it's been really fun. We come up
Yeah,
on time. Tell us where folks can follow along with what you're doing or get in touch if they want to.
yeah. My Twitter is a good place to reach out. Value don't lie for any of the Rasheed Wallace fans out there. And my email is Colin, Colin, at circlecitycapitalgroup.com. Happy to field emails too.
JT, want to plug Journalytic?
We do that every week. It's fine. We'll just get it
Well,
next week.
I'm gonna plug my book.
Yeah,
I
let's do
can't
it.
read it, can't see it.
You got it. Yeah, there you go.
Soldier of Fortune, the Kindle version is out on 16th, which is Thursday.
Is it true that you got Gilbert Godfrey to read the audiobook?
No, I got the same gentleman who
Oh, okay.
did Acquirers Multiple. He's NPR in Atlanta. He's got a great voice.
Legend.
But Colin,
Legend.
thanks so much.
Yeah, it's great, Colin. Thank you.
Thanks, guys.
Thanks.
Appreciate you having me.
Our pleasure. We'll see you next week. Same bat time, same bat channel.
Luca.
We got Luca.